Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I got two paper money practice trades for you to look at today. We'll look at two very high-profile names. Number one, Nvidia, and number two, Boeing, that's had a very quiet rally up from its lows over the last couple of weeks. But before that, let's get to our macro minute and look at what's happening here in today's market. The markets are down slightly today. We just got some JOLTS data at 9 o'clock Chicago time. Job openings and labor turnover survey is what that is. 7.74 million open jobs. That's a little higher than last month at 7.44 and higher than expectations of 7.49. What does that do? That means the labor market, job openings is increasing, indicating a strong labor market, much like the readings we're getting every Thursday on first-time filers for unemployment insurance, jobless claims. Those have been historically strong the last several weeks. Is that setting us up for a strong non-farm payroll number on Friday? Let's keep watching as we'll get ADP tomorrow, jobless claims on Thursday, and then non-farm payrolls on Friday. All right, that's the macroeconomic data for today. Now let's get to our two trades. The first one we're going to look at, Nvidia. Nvidia is an interesting company because it almost feels like, because of the stock split, that large, high-profile traders are shrinking their positions in Nvidia just because the stock has run so far and they probably got, 10 times the stock they used to have. So that's what seems to be holding Nvidia down. It's got to get through this period because the earnings were spectacular, right? $2 billion beat to revenue above consensus. Year-over-year growth, 94%, up to $35 billion in revenue. Yet, the stock is lower off those numbers. So the overall PE, the valuations are getting better for Nvidia going forward. So it's still, however, I think it's very important. If you look at the 50-day moving average of $136.50, violated it, now holding above that 50-day moving average. You can see it right there. The moving average on the Thinkorswim platform that I have, 136.57. So keep watching that number and that it holds it. Remember, analysts are calling for 40% revenue growth over the next 5 quarters. That's 1 to 2 years. So everyone agrees that the margins, the valuations are, especially the margins, are unsustainable long term. But we don't know what long term is. And right now, with the Hopper chip leading to the Blackwell chip, with the Rubin chip waiting to go next, just as they start shipping the Blackwell chip, Nvidia, pretty interesting time in its history that we're in right now. So the paper money trade, the practice trade that we looked at today, was something in a more passive long delta. It only gives you about 17 long deltas. It's in the calendar spread family. We're going to compare and contrast the calendar spread to the diagonal in today's Daily Trader. This one is a diagonal spread. What's the difference? We're buying the December 27th, selling the December 6th, same strike, 145 strike. So about $7 higher than where we are now. You've got some duration on this. As you know, you've got 25 days till the longs go off. But this is trading for, I put it in there around $2.70. It's currently trading right around $2.50 now. So if you think about this, this is a calendar spread, a traditional calendar spread, where the risk is the debit paid, in this case $2.70 on the screen or $2.50 where it's trading right now, and you're collecting theta each day. You're long about 17 deltas on this trade, and you're looking for a move at or near the 145 strike. The risk on this trade, a move down away from that 145 strike, as you can see by the risk graph there, or a large move through that strike and much higher. But in all cases, the total risk on this trade right now is the debit paid, which is somewhere between 270 and 250. So that is The one thing about that, it collects data. It allows you to extend duration on this trade into the upcoming weeks as you chip away at not only the net debit, but the break even as well. All right, so a call calendar in NVIDIA. Now let's get to our next one. One that we talk about a lot, one that I follow extensively, and that is Boeing. Now, very quietly, if you look at the chart on Boeing, it's had a nice rally off the 137 lows since about the 14th, 15th of November, right in that range, up to the 155, almost 156 level. So it's very quietly come off its lows. Why? Well, it's got a new CEO. It was able to raise capital to cover the downtime during the strike. It's also settled the strike. It's streamlining its business. It's announced some layoffs where they're consolidating some businesses. Stabilizing production is the key for Boeing. What Boeing needs is to, have the FAA agree that the Boeing 737 MAX and the 787 are flight worthy and ready to go in the air, get approval from them, get these government agencies, for lack of a better term, off of their backs and let them deliver these planes that they're building. And that does several things. Number one, it reduces your inventory, right? Gets them planes out the door. You have planes being stored all over. Get those delivered. It increases free cash flow, right? You take in the money when you deliver the plane. That makes your balance sheet better, gets you closer to profitability and back into the black in terms of profitability of this company. So Boeing has a lot of other things. Current inventories that they have, planes that they are at or close to delivering, $83 billion. $72.1 billion of that is commercial planes. So think about that. Those are 737s and 787s. If they can start delivering those, the ball will start to roll in the right direction. We've already had kind of a reverse of some of the negative news on Boeing, right? With the new CEO, with the settling the strike, and with the raising capital that was relatively easy for them to do. So that's a good sign. They need to deliver their stored airplanes, the 787 and 37 MAX. They need to cut the commercial in-plane inventories, right? That's key. That can immediately throw $35 billion onto their balance sheet. Free cash flow equals healthy balance sheet equals profitability. That's the key for Boeing. Deliver planes. So looking at that and its recent rally, the practice money, paper money trade we looked at here in Boeing is similar in the calendar spread family, but we're giving ourselves a little more delta. Difference between about 16, 17 deltas and 25, 26 deltas. Same months. Buying the December 27th, 155 call. Selling this week's December 6th, 160 call. Now, I put that in around $4.55. It's trading a little higher than that. It's trading closer to $5 now as the stock has rallied slightly off its recent lows. So this is a diagonal. Remember, you look at a $5 diagonal trading around $5, it can cause it fails sometimes the eye test. But, however, if you think of the fact that on the December 27th, you've got 25 days. If any move up towards 160, if you manage the trade and move those 160s, if you get that rally, this is a trade that is built for the upside. Remember, again, like the calendar spread, the risk on this trade is the debit paid. In this case, somewhere between $4.50 and $5 is where it's trading. But this is a more aggressive version of the calendar spread. Why? Because it embeds the call vertical within that calendar spread, right? The 155, 160 call vertical embedded inside the calendar spread. So a calendar spread, diagonal spread lesson today on Daily Trader. One is a little more delta. both collecting theta, both in the same family, but both are bullish. Remember, if you're not bullish in Nvidia, not bullish in Boeing, these are not the trades for you. They both have a bullish bias going into the next several weeks. That's our show for today. Thank you for tuning in to Daily Trader. I'm Kevin Hincks. Have a great day, everybody.